Okay, thanks everyone for coming, and welcome to our guests in the room with me today or this evening, and our online guests. I think there was about 80 to 100 RSVPs for the online, so it's a good turnout, so welcome. Tonight it's just a Q&A, so it's the second one we've done in the last few months to just invite investors or prospective investors to ask questions of us, but also invite an expert guest speaker along to talk about what they're seeing out in the investment markets. And today I've got Clive Todd. He's a partner at Mazars, and he's a partner specialising in self-managed super. And about 85 to 90% of our investors do so through their self-managed super fund. So I thought it'd be good to get Clive. He's got some good insights in that space. Some of the trends he's seeing, a lot of the technical challenges that are coming in the SMSF space in the last 12 months. I certainly, I hold an SMSF and the compliance obligations are getting more difficult, but luckily for me, Clive handles that. So I'll just welcome Clive, and thanks for coming, and Clive will run you through his presentation.
Thanks, Andrew. It's great to be here tonight. I'm obviously very passionate about superannuation and the opportunities that are there. So tonight I just want to sort of give you a bit of an insight into what I'm seeing. So at Mazars I look after approximately about 400 self-managed super funds. So good cross-section of what's going on. I see what people are investing in, what they're doing, and why they are in self-managed super. So I'll talk a bit about that, and then leave you with a couple of little strategies that I think and things that we're going to see more of this year with some of the recent legislative changes. So things that people would want to probably just keep in mind, and by all means talk to your accountant, talk to your advisor about later. So
I should have just said, any questions online or in person to either myself, but probably Clive while he's talking. Don't be afraid to jump in on the spot. Don't wait till the end. Just get your questions in as we go.
Yeah, definitely. If you see a slide that's got something on it that's of interest and you just want to dig a bit deeper on it, phone me a question, please.
Yes, yeah.
You might not want to, but
This is my best angle, this one.
Firstly, a disclaimer, everything I'm saying is general advice. I haven't taken into account anyone's personal circumstances, so disclaimer way up front now. We don't leave it till the end, we do it up front. So as I said, trends and statistics, and then just some strategies is what I'm going to talk to today. Right, firstly, self-managed super funds. There's a lot of them in Australia. The most recent numbers I've got is 2021. Unfortunately, the numbers are going to be published within the next 2 weeks, so I don't have the 2022 as of yet. But as you can see here, there's steady growth in the numbers of self-managed super funds. Currently, around that 600,000 mark is where I'd probably think. So a lot of people do have them, and about over 1 million members. Now, Andrew sort of mentioned it before, it's interesting to see the number of funds being wound up, and I think going to the point around how complex it's become over recent years, people are just getting a little bit sick of it in the first instance. That's one of the reasons I think people are getting out of self-managed super funds. Secondly, you can also look at the fact that people are running down their balances. So self-managed super funds have a little bit of a life cycle. If you've started out with a couple of $1 million and then you've gradually whittled it away by using it for your retirement spending, you get to a bit of a tipping point going, well, I don't need it anymore. It's not worth the cost and the hassle. I'll wind it up. So I think when you look at 2018, there was a real lift in the wind-ups because that was when some of these extra reporting requirements came in. And I think that was a real kick. People just go, I couldn't be bothered. Saying that, coming back into 2020, 2021, we all know what sort of happened then. COVID sort of crept into daily life, and with uncertainty, I think Australians run to looking after their own financial situations. So we've seen people coming back, like I've suddenly had people actually inquiring and setting up over the last 2 years because they say, well, if the big funds can lose money, so I can do that myself. So I may as well look after it and make my own decisions. So in periods of uncertainty, we tend to see people wanting to take advantage of that. And I think people are becoming more aware about what they can do inside a self-managed super fund. And I'll touch on that in some of the next slides. But there's so many good opportunities and things you can only do via a self-managed super fund that you can't get via any of the big ones. the number of amount of money that people have in these funds is quite substantial. So the average superannuation balance in Australia hovers around that $100,000 mark. But as you can see in self-managed super funds, it's getting up towards that $700,000 mark, which again means it's skewed a bit because you tend to have older people inside self-managed super funds, and they tend to be the ones with more money to invest. But that's where I guess the target market of SMSFs remains, and that's where the government is trying to, I guess, aim people looking after their own money if they've got sufficient capital to do so. And it has increased. I think it's interesting to see over the last 5-6 years the balances are going up, and it's not just because of returns. I think the legislative change has also led to people not taking out as much of their super. And if we look at the next slide, you can really see the balances. Gone are the days of where you had like the small funds with like $50,000, $100,000. They're gradually whittling away because it's just too complex, it's too costly, and there's no real reason to have one if you've got $100,000. And that has been why the government sort of brought in some of these complexities. I think they don't want people effectively doing these for the wrong thing. And a lot of the ones in that sort of $0 to $100,000 often have set these up to access their money illegally or do something wrong. So trying to cut those out. But what you'll see in the bigger end of town, it's getting a larger percentage. So more people are having more money inside their self-managed super funds. So as of now, I think there's at least 10 super funds in Australia with over $100 million in them, and the largest is $540 million. So the bigger funds are going to continue to get bigger, firstly just from the fact that there's investment returns, but secondly, as you may or may not be aware, you've now limited in the amount of money you can have in a pension inside your super fund. So they started that back in 2017. You can start a pension with $1.6 million. If you had $10 million and you were drawing that down, suddenly you could only have 1.6 in pension phase. So you're actually not required to take as much out of your fund. So hence funds will keep getting bigger. Now the government was very anti on having self-managed super funds as a bit of an estate planning vehicle. But with this legislation, they've essentially created that. So people will have super forever in a very tax-effective environment and then pass it on to their estate. So it becomes more important to plan accordingly. It's all tax-free while you're alive. If you're over 60 and you're pulling it out, there's potential tax when it goes to non-dependents when you pass away. So what we're seeing is a lot more focus on what is going to happen in the event of members passing away, because it can be, it's not a death tax. Nobody likes to refer to it as a death tax, but when you pay no tax when you're alive and somebody pays tax when you die, it tends to look a bit like one. So very important. If it doesn't matter how much you've got, but focus on what's going to happen in the event that you're no longer with us. Now, what are people investing in? I think it's quite remarkable that still direct equities is the number one go-to inside self-managed super funds. So this is the amount of money, this slide, that people have invested in these different asset classes. So SMSFs, 31.5% of funds inside SMSFs in Australia are straight into direct equities. Now, there's probably various reasons, but the most obvious is still the franking credit system that we have in Australia lends itself towards, in a low tax environment like superannuation, people want those franking credits. It offsets the tax they pay at 15%, or they get it straight back if they're in a zero tax situation. So, and it's what you know. People walk past Woolies, they walk past Westpac, they invest in it. So direct Australian shares tend to still be the number one go-to. The irony is there's so many competitors to self-managed super funds where you can do that. So this just shows you that it's not really saying what else people are doing inside those super funds. The next one is property, and I think again that's the main reason a lot of people still go into self-managed super funds. The only way you can buy a property directly with your super is via an SMSF. So Australians love property, there's no denying it. What we're seeing now though is that it's getting harder and harder to satisfy, and Andrew can see this himself. When you have properties, you have unlisted investments, you have private companies inside your self-managed super funds, the scrutiny and the audit requirements being put on it is making it harder and harder and more costly every year. So that's where and I don't mean to segue into a shameless plug for CFMG, but that when you're investing via unlisted trusts and getting into property via companies like CFMG, they provide you all that audit requirement. They give you everything that the auditor needs to satisfy themselves. So it is making it a lot easier. So I'm seeing quite a shift away from people doing it directly and all the hassle that comes with that, and starting to go into, all right, I'm going to have somebody that knows what they're doing, look after my property investments, and they provide me with everything I need to tick the compliance boxes as well.
So Clive, with the direct property, do you think a large proportion of that might be, it's quite common for businesses to buy their premises through the self-managed super fund, and it's the only function within your SMSF where you can buy property and still take a benefit from it? Is that,
yeah, definitely.
would that count under that direct property?
So back in when they first brought in the borrowing, ability to borrow via a self-managed super fund and invest in property, there was a big shift into residential. Everyone goes, well, I like investment properties, I'm going to buy a unit, I'm going to buy a house, I'm going to rent it out. But then suddenly there's all the restrictions that come with that. You can't use it yourself, you can't buy it off yourself, limited probably yields compared to some of the commercial ones. So people have now shifted more into, if you are buying direct property and especially borrowing to do it inside an SMSF, it tends to be business property. So either business property that a doctor buys his rooms, or you're doing it to lease to somebody else, because it tends to just have that a bit more flexibility around it. So we've definitely seen a skew away from residential and more into commercial from a direct point of view. People tend to get their residential exposure via other products. The other big one there, and I'll just mention quickly, is the growth, and we'll see it on the next slide, of ETFs. Like, I'm sure everybody's come across ETFs, but you can pretty much get an ETF that invests in anything nowadays. So if you've got a little bit of a yearning for something that's a little bit niche, rather than go and try and find individual stocks that are focused on that, you can buy an ETF, and they're low cost compared to some of the other options, investment options around. So they've actually been steaming ahead. Everybody seems to be getting into ETFs. It's easy, it's cheap, and it seems to give people that diversification. Now we look at the who's investing. Well, 99.4% of funds have cash. That makes sense. I don't know what the other 0.6% are doing. I'm a bit surprised they don't have any. But this is where you really see that ETFs, like 28% of SMSFs now have ETFs. Yes, sorry. It's an exchange traded fund. So what that means is that they're listed on the stock exchange, and it's effectively like a managed fund where they are investing then in other shares. So, but they've got the advantage of being liquid, so you can buy and sell them on the stock exchange, whereas managed funds are less liquid, and there's a bit more of a delay in getting potentially funds out of it, and they're unlimited in quantity. So if you are investing in them, they'll just go package up as many as they can, and you can have them for banks, you can have them for top 20, so there's a wide variety, and so they're definitely coming through. The reasons, again, like I still feel if you're going to be going to an SMSF, what you're probably aiming is that direct property and your unlisted trusts, some of that stuff that you're not going to be able to get exposure of. So we are seeing that still grow quite a bit around that unlisted trust, and I do think that's where we'll see more and more people getting exposure to that, because they've got cash inside their super funds. They're not necessarily wanting to get direct shares at the moment, especially. Hence, where do you go? I haven't got enough in there to buy a property outright. I can get a piece of something else. Now, what are they doing? Like the government's always pretty keen to keep a track of what's happening. Are people actually making money in their self-managed super funds? There's always the concern that people are losing. They set up their own funds, they look after themselves, and they do a bad job of it. Now, statistically speaking, Apra funds do outperform super funds most of the time. There's various reasons around that. I won't go into all the industry funds versus SMSFs, but I think one of the interesting characteristics here is if you actually exclude the low balance funds and the funds that have just been set up and people have just sat in cash, they do perform better, or at least comparatively to Apra funds. So my takeaway from all this is essentially, I feel the opportunities to be investing in what you want to be is still the big tick from a self-managed super fund. And that's before we get into all the other strategies, etc., that we'll touch on in a minute, but just from a purely investment point of view. But however, you need to have that scale. The costs involved and the complexity involved, it doesn't necessarily add up if you don't have that much at the moment under the current system we've got. I do think we'll continue to see growth in the SMSFs, and an interesting point around that, I'm not sure if anybody's kept track, probably not just me, but Hub24, a listed investment platform company, has recently taken over Class, which is a SMSF administration software company. Now, their motivation to do that is because they anticipate that in the next 10 years, like we saw the numbers before, it's about 1 million people have self-managed super funds or members of. They anticipate that number's going to grow to 5 million. So they're anticipating huge growth in the SMSFs space. The only way that's really going to happen is if it gets easier to do and people start to want to have better understanding and know they can look after their own money and know that it's not going to be too complicated and the government's going to come after them. I think that mistrust still is, people don't have the confidence in sort of at the moment doing it because they think the rules will change or the government will just pull the rug out from under the feet. But so scale and then do something with it. I think again, when you see, if you're sitting in cash inside an SMSF, you may as well probably be somewhere else and not paying as much. So have a plan. If you're going to set up a self-managed super fund, do it for the right reasons, do it with sufficient capital, and then invest accordingly according to that plan. So that's pretty much like a bit of an overview of some of the trends I think I'm seeing. Yes?
I was going to ask, would there be like in the future any possibility, because I'm still with the, the Apra funds, like would they open up like more avenues for like investing, like say in those unlisted equity funds?
Yeah, sorry. So the question is whether APRA funds will.
Yeah, besides self-managed super funds, will there be a possibility like for those APRA funds to allow investment in those unlisted equity funds like CFMG?
The big APRA funds. The question is that will APRA funds allow or open up to unlisted investments?
A bit still quite restricted, all those APRA funds.
APRA funds are firstly, what we'll see with APRA funds and the big funds is probably a lot of consolidation over the next 5 to 10 years. You would have all seen that Sun Super and Q Super have just recently merged together. And the reasoning behind that is, again, it's very hard to, when you've got such scale, invest. Big funds, when you're trying to invest $200 million at a time, you're not going and buying a few BHP shares or something. They are going and buying entire airports and entire toll roads because they've got so much capital. Like the superannuation sector in Australia with $3.5 trillion in it is a big beast, and it's saved the country, obviously, given that stability through a lot of tough times. But now the big funds are very powerful on the world stage. So I think Australia has the highest level of investment as a country in infrastructure in the world. So Canada's second, and that's again because they've got a very big pension scheme. So what we're going to see is the big funds are going to end up coming more and more together to pool their resources. The second reason they'll do that, not just from an investment point of view, is that if you've got a lot of funds that are getting to that baby boomer age of their members where they're starting to draw down. Now, if you've gone and invested in an airport or a toll road, it's very hard for you to cut off part of that airport and pay your members their pensions. So liquidity becomes a big factor for these big funds. So they're looking to go, okay, what's a fund that's got a lot of contributors? If I'm going to be paying out to my members here that are getting into the baby boomer age and drawing down, I need people that are going to tip in to be able to mean that I don't have to sell investments and big assets at the wrong time. So I don't think we'll see much in the way of the big funds looking at smaller unlisted investments because it just isn't on their scope or scale. It's very hard for them to tick the boxes. They have an investment committee that has to sit down and vet every single investment, every single asset purchase, and if they're doing it for a $5 million investment, and when you're doing that for $1 billion, it's a lot. So they will only probably ever remain at that big end of town. So I don't think that you'll get, as an individual member of the funds, the choice to sort of go, I'm going to put some money in CFMG or something similar like that. I'm not sure if that answers your question in a long-winded way. But yeah, so any other questions around what's happening in I guess, superannuation? Like, I do think it is very interesting talking about how much money is in there and what it's going to be used for in the future, like yeah, where it goes.
Clive, you touched on earlier the cost of managing a self-managed super fund. To your knowledge, are there any ways that we can manage our super fund better ourselves rather than the traditional accountant method?
Yeah, well, unfortunately, I think what happened is for a long while there you could, because it was, you know, I come along once a year, prepare my financial statements, I get them audited, I'm done. Now with the reporting requirements that are in place to be done throughout the year, let alone, like if you're starting pensions, if you're rolling over, if you're doing anything, it needs to be reported effectively in real time. So it's got harder and harder to do that without, firstly, people that know what they're doing, that are staying up to date with the constant changes, and also software that allows that to be reported. Like the constant changes are just making it harder and harder to report these sort of things. Everything has to be done, like SMSFs are now entirely in the SuperStream world. So we're finding this is a really big issue at the moment, that if you're wanting to roll money to a self-managed super fund or out of a self-managed super fund to a big fund, it's all got to be via SuperStream. So gone are the days where you just write a check and send it off, or BPay it. It's now request it here, request it there, and if it doesn't match up with some one of the bank accounts different to what they had from the ATO, then it's totally rejected. So all those requirements are pretty onerous for people to do. The only way you can make it cheaper and easier, and it was a race to the bottom, I think, on costs. Everyone was getting very automated, everyone was getting very competitive in that. But now I think what we're seeing is that it's leveled out and it's going to start creeping back up because it's just hard to do. It's just time consuming. And what we see is the clients probably don't necessarily realise what goes on behind the scenes a lot, because we're trying to streamline it as much as possible for them. But my frustrations build and build with the reporting obligations. The lodgement deadlines and everything else has still stayed the same over the years, and there's no real allowance for all this extra work that's needed to be done. So the client's sort of going to end up just paying more and more for what's going on that's sort of outside their control. The only ways to make it easier is invest in, have a bank account with a major bank that has feeds, invest in companies that sort of provide you with the right information that makes it a lot easier for the accountant. But I struggle to do it. I couldn't do it myself without the use of software and people in my team. So I'm not sure it would be possible.
Sorry, for those at home, the question was, is Clive aware of a methodology to manage your super yourself without having to use the traditional methods of accountants and things like that? So I'm not sure you'd tell them if you did know. But
one final addendum to that is that there will be, what we will see, like that 5 million members that they anticipate, like Hub, the reason for that is because there will be options to do it more yourself, very automated. But I'm not sure how successful that would be, because with the requirements we've got around setting up super funds and the advice required, because it is a financial product, it's going to be a tricky one. And that's only if you keep it very vanilla. Like as soon as you want to go get a property or something else.
My answer to that question was there are providers that have set up software to automate as much as you can. But the moment you go down that path, you're restricting your investment options, which is often the entire reason that you set up your self-managed super fund, was to not be restricted in your choice. But if you want to use a low-cost self-managed super fund provider, you'll then be restricted in your choice, and it becomes counterproductive.
Yes.
Can I ask a question? Apparently, since the 1st of June or July this year, people over a certain age, I think it was 65, they can put into their self-managed super fund. I don't know if there's a formula, but I've been told 250,000 or so. I don't quite understand that. Okay, we can add 250,000 to our super. and then it's going to be all of a sudden tax-free because it's within the super? Can you
I'm
explain
just
that?
about to get.
Okay.
Yeah, you've got ahead of me. So yeah, if there's no other bits, I'll jump into the
I've got
strategy.
an online
Oh, yep.
question quickly from Paul. Clive, are you seeing anyone investing in gold and silver as potential inflation hedge?
I have seen, and again, periods of uncertainty, people do run to a bit of bullion. It's, again, possible to do via a self-managed super fund, but there is rules and restrictions around it. So the best way to do that, and we see got quite a few clients doing that where it's being held at the mint and it's been safely stored, because you need to tick off that the auditor needs to be comfortable to say, yes, that exists. I haven't gone and bought gold and then I've gone and melted it down and put it, made a necklace, or I've gone and spent it at the casino. You need to be able to prove it actually exists. So the easiest way to do that is have somebody else look after it for you. Or there's a variety of options around investing in bullion through different products, some of them listed, some of them unlisted. So, but the short answer is yes, people definitely lean towards bullion in periods of uncertainty. Yes.
During COVID, we were allowed to pull out $10,000, which I had to do myself over 2 financial years. I put out 20 grand, and my intention is to put that back in, but is that such a small amount it doesn't really appear in the data? And are you seeing people generally putting that money back in that they had to, for whatever circumstance, pull out?
Yeah.
I'll just repeat the question.
Yeah.
Just for those at home, the question was relating to the short-term legislation changes during COVID about being able to remove $10,000, basically an early release of $10,000 from your super fund, whether it was an SMSF or an Apra fund, and whether Clive's seeing people now trying to put that money back in now that the economy's settled.
Yeah, so again, I haven't really. Like most people that did pull it out did probably need it, and they probably have used it. If they've got circumstances have changed and they've got the ability to make contributions now, there's other ways that they're sort of putting it back in rather than just reimbursing, and potentially they're looking to take advantage of some of the things I'll talk about in a minute. So I haven't seen a lot of people do it, is the short answer, but it is an option, and everyone tended to do it if they could, even if they didn't need it as well. But a lot of those people sort of just spent it as well. Like there's a reason why the economy got stimulated a fair bit, I think, and it wasn't just JobKeeper, and super withdrawals was also a big one. But you're right, like $10,000 is probably, I've said to people before, like if you've got, like the government worries about people with $100,000 in super and goes, they need to be building it up and don't take it out and that. I sort of sit there and go, if you've got $100,000 in super, you're not going to get through retirement just with that anyway. So you may as well pull it out and buy a car or go on a holiday, or this is not financial advice, but it's probably going to get whittled away anyway. Yeah, exactly. So
Adding to his question, if you put back the 20,000, is it considered? It's not tax deductible, right?
No, it's effectively a reimbursement.
It will be a non-concessional.
Well, it doesn't count towards the limits because it's effectively putting back in what you took out. So it does give you
tax benefit.
Not really.
Okay.
It's just a reimbursement, so to speak. But you're getting into some of the strategies there and the things I think that what we'll see this year. And this is what I think you were alluding to before. The work test has been abolished for people over the age of 67. So currently, if you're over the age of 67, last year, you had to be working to put any money inside superannuation to make a contribution. So what they've done is we'll remove that. Now you can make non-concessional and salary sacrifice, so not all types of contributions, but if you were aged between 67 and before you turn 75, you can make non-concessional and salary sacrifice contributions. So that's only from 1st of July this year, and I think this is opening up the playing field to a lot of people that have sort of been, potentially stuck with money outside. They've inherited money, they've won the lotto, had a big win somewhere, and they've got cash outside of super, and they weren't working, they weren't enticed to go get a job. Now they've got the ability to potentially put that into a very tax-effective environment, boost their super again, especially if markets have dropped. Like if you had a balance and it's suffered during this period and it's dropped down, you've now got the ability to pop it back up again with cash that you were stuck with outside before. Now, it does get restricted by the usual contribution limits. So firstly, non-concessional contributions are $110,000 a year at the moment that you can be putting in, but you can do 3 years worth, so up to potentially $330,000. But if you've got more than $1.7 million in super, and that's across all your super, like, so if I've got 4 super funds and they've each got $500,000 in, I've got more than 1.7, I can't make these contributions. I can't make non-concessional contributions.
What happens if your super fund has more than one member?
That's still member-based. So if you've got $2 million in a super fund, 2 members, and they've each got $1 million, they can still be contributing. So it's a member-based balance restriction. So I really think we're going to see a lot of this. Now, the catch here is plenty of people's eyes are lighting up going, well, I'm going to, I've got all this income, I'm getting rent, I'm getting dividends, I'm getting interest. I'm not working, I'm going to put in my $27,500 that it is now and claim a tax deduction for it, a concessional contribution. Well, you can't do that unless you're working. So this is really that after-tax money. It's just that parking money inside the superannuation environment. But I think it's going to be very popular for people with less than $1.7 million, aged between 67 and 74, will suddenly get the option to invest. Like if you've got investments outside of super and you're paying potentially tax on that earnings, you can suddenly get them inside of super and look to take advantage of the tax benefits inside super. Now, again,
So you can move the investment, not just cash.
Depending on what the investments are. And again, with that, like you can do in-specie transfers of listed securities, widely held funds, but there's also potential tax consequences. If you sell something and move it into your super fund, it's essentially a disposal, so you may be realising a gain. So always be careful about moving assets. You don't want to sort of cop yourself a big tax impact because you've moved something into a superannuation fund. Cash is the nice easy one. If you've got cash, you can be putting it in, limited to the restrictions. Like again, always make sure you talk to somebody and make sure you can be doing it. But it is something to keep in mind, and I think that we'll see people suddenly taking advantage of that and boosting their super.
So you can't move investment properties into the super?
So the question was, you can't move investment properties into the super?
It comes back to the restrictions that Andrew referred to before around residential and business property. So a self-managed super fund can't acquire a residential property off a related party. It can acquire a business property. So if it's business real property, it can come along and it can buy it off the member. It can potentially be contributed as an in-specie contribution. But if it's residential, it can't.
When you say in-specie, does it have capital gains tax implications?
On the disposal, yes. So, yeah, sorry. The question was, is there capital gains implications from an in-specie contribution? And yes, it's effectively a disposal. So if you are transferring an asset from yourself or some other entity into super, it's a disposal to whatever entity or personal has sold that or transferred that asset. So hence you always want to be careful and not necessarily incur gains that you weren't aware of by doing it. But yes, so it is definitely opens the door, and I think it's going to open the door for a lot of strategy, a lot of discussions, because people that have just been sitting there, suddenly there's potentially options for them. And the other one there that I'll mention quickly without going into too much detail is rebalancing. So what we've probably ended up, like I referred to the limit that you can have in pension phase and get those full tax benefits. If you've got one member with $2 million and one member with $1 million, and this member with $2 million hasn't got it all in pension phase, they can effectively be pulling it out and giving it to the other member. So what we might be able to see is some equalisation of balances to get better tax benefits for couples. So again, there's so many variables to this, and it obviously depends on the personal circumstance and situation. So it doesn't make the point. If you are aged over 67 or know people aged over 67, depending on how much they're going to super, start asking questions and see where there's options around. Now the next one is probably aimed again at people under age 67, but it does still people over 67. there's the ability to carry forward. And I don't know if anybody's probably seen this. It sort of flies under the radar a bit, but if you don't make your full concessional contributions, which is the contributions you claim a deduction for each year, if you don't make your full limit, like cap, up to was 25,000, it's now 27.5, it carries forward. So I've only made $10,000 contribution this year. My extra unused 17.5 carries forward for up to 5 years. So what that means is that you can then do it all in one hit, or go over your annual limit, depending on what these catch-ups are. Now that's been around since 1st of July 2018. So this year is the 5th year. So some people, if you haven't made a contribution in the last 5 years, you could essentially be putting 5 years worth in one hit. But you have to have less than $500,000 in super. So that's a bit of a catch. So that will stop some people. But if you're in the situation where you've never really had the circumstances or the opportunity to make contributions into super, you might be able to sort of do that. Like if you're sitting there with 200 grand and you've got a big capital gain, you can potentially do it. And I've just got a bit of an example here.
Is that based on members? So
again,
if you've got a self-managed super fund with, say, a stay-at-home mum who's not earning an income and a parent that is earning an income, the stay-at-home mum may have earned up to 140,000 of concessional contributions in the last 5 years.
Yeah, exactly right. So they can, if you've made no contributions, and you've got $100,000, but the other spouse has $1 million, it's still member-based, that restriction. So, and here's a bit of an example of just how it can sort of add up. So back in the 2019 financial year, your limit was 25,000, only put in 15, effectively 10,000 carried forward, and you can see it just add up. So then in the 23 financial year, your balance in this situation, your ability to contribute, is actually $90,000. So again, if you've got the means and the ability to make contributions and you haven't made your full contributions in the past and you think it could be beneficial, talk to your accountant, see what your options are. This information is actually available on MyGov. So again, we talk about making things a bit easier for people. The government does have some avenues where you can gain information yourself. So you'll be able to log in there and see, firstly, what your super balances are, and also what your unused concessional caps are. So a couple of little ones here is also what we're seeing this year already, well in the last couple of years, is if you're a 15-year-old, you've still got a contribution limit. Now, you get to 18, suddenly you've got 5 years worth of concessional contributions that have built up. So we're actually seeing distributions being made to kids rather than pay tax to the taxman. It's a case of like, we'll distribute to the kids, make the contribution to super, and take advantage of their concessional contribution limits as well. Yes, it locks that away for the next 40 odd years, but people are weighing that up. So, and that's the same as if you're 72, you might not have contributed for 6 or 7 years, but you've suddenly got the ability to have had that carried forward depending on what your balances are. Catch there is that you need to be working to make the contribution if you're over 67. So, but again, carry forward, keep that in mind. I think it's going to be a very useful strategy, and this year is the last year. If you didn't make your contributions back in the 2019 year, if you don't make them this year, they're no longer carried forward. So first year we've come to for that. And the final one, just again, we talk about obviously restrictions on getting money into super, but there is quite a few avenues coming forward. And the downsides, I'm not sure if everybody's heard of this, but it's where if you sell your principal place of residence and you've held it for more than 10 years, you can make a contribution of up to $300,000 into super. Tax-free, no restrictions on balance, so you could have $10 million, you could have $540 million inside your super fund. You can still do this. Now they've reduced the age down to 60, that takes effect from. So it was 65, now if you're 61 and you sell your principal place of residence that you've owned for 10 years, you can be tipping in $300,000 into super, tax-free.
There's no age ceiling, right?
Yes, the question is there no age ceiling? And you're right, you could be 110 and you can still do this. You just have to be 60 now as a minimum. So whether or not it sort of gets utilised here, I think the catch with this one is that you put it in at 61, you might not be able to take it out again. It's always been easy, 65 being the number, because if you put your money in, you had full access to your super to pull it back out again. 60 might catch a few people. It seems like a good idea and you go, I'll take advantage. And then you find you haven't met a condition release, you can't get it back out. So again, depends on your personal circumstances, but it does open the door for people selling houses. Now, the other thing to just mention there is that you can do it twice. So it's $300,000. Say I did it at the age of 61 and I'm like, well, I can't do 300 at the moment, I'll do 100. I come along in 10 years and I've had my next house for 10 years, I could do it again to top up that 200,000. So it's a case of like...
but it's a lifetime limit of 300.
Like, yeah, $300,000. So you need to sort of just be a bit careful. Doesn't matter who. I think the other question we get quite a bit is, oh, the property's in my wife's name, so I can't do it. Well, yes, you can. It doesn't matter what name the property's in. If it's your principal place of residence, you can definitely do it. Because you only see a lot of people do it for asset protection, have houses in different spouses' names. That's irrelevant. You can still be taking advantage of the downsizer. So again, it's an option to get money in. I guess a bit of an aside, one of the most common times I see this is people going into aged care. So they sell the family home and they actually can then top money up into their super, which is quite ironic. I think someone 95 and they're putting the 300,000 in. But it is tax free when it goes in and it's tax free when it comes out. So talking about that estate side of things, it's not too onerous. So that's all I've got, like a couple of brief strategies. I've very much just scratched the surface of those, so it's more a case of trying to just make you aware of some of the things that are around, but there's a lot of nitty-gritty behind it. So if you think there's something of interest there, like I say, talk to your accountant, talk to me, happy to sort of to help out and make sure you get the right sort of advice for your personal circumstances.
Beautiful, thanks Clive. Yeah, there's some good stuff in there. Makes me think I should talk to Clive more often. It's an easy. But if you've got any questions for Clive or myself, now's the time. Both either about us or what.
All these reporting conditions and requirements, what is the actual benefit for me?
Yeah.
The question was reporting conditions and requirements. What's the benefit to the actual self-managed super fund holder?
It's an interesting question. I tend to err on the side of there's limited benefit for you, but I'm assuming that you're one of the people doing the right thing. So unfortunately, all these reporting and restrictions and checks and balances seem to come in place, like we tend to do with a lot of things, to try and stamp out the people doing the wrong things. Now, I sit in the world of accounting where we've had to go down, and I talk about setting up a self-managed super fund. It's now a financial product, so I can't just tell somebody you should set up a self-managed super fund. I can't sit here and say you should make a contribution, because that's all financial advice, and because a few people may have been doing that in the wrong situations, we're now all obliged to abide by those rules, and that's the same thing with reporting. One of there is benefits though, and I think what I should highlight, it's not all doom and gloom about that. Like, I think we are in the age of where information is more freely available. So as a self-managed super fund member, you can sort of sit there and say we're talking about contribution strategies, and you talk to your accountant and you go, well, I'm not sure whether I've got enough, I breach these limits or anything like that. Well, they've got the information at their fingertips a lot easier and quicker than 9-10 months after the 30th of June like it used to be. So you can take hence advantage of more strategies because of, I guess, the better reporting, the more automation that's been done throughout the year. So that's one of the benefits. The other thing is moving around. Like, I guess it's a lot more, you've got money at 5 different super funds, which doesn't happen as much anymore, but because they've got all this, we have to have your self-managed super fund up to date. It means you can then bring money in from your Apra fund or vice versa. So I do see some of the benefits like that, but unfortunately for the clients, it just results in paperwork, even electronic paperwork, and compliance and cost. Exactly right.
Can I ask, once you convert, let's say, funds from accumulation phase to pension phase, you have to, so once you start your pension phase, you have to have minimal withdrawal, is it? There's no way that you can just leave it and then let it just accumulate without any withdrawal? Is there no way like
Yeah.
the pension?
So the question is about when you start a pension from your accumulation account, do you have to be taking a minimum withdrawal each year? And again, the answer is yes. To maintain that pension, you have to be taking out that minimum. Now, that is one of the things that's happened again this year, is they've applied a 50% reduction to that minimum amount. So instead of having to pull out, say, 4%, it's only 2% of your balance. But the requirements are, to maintain that pension, you need to meet that minimum requirement. Now, there's no requirement for you to have a pension in place, and I think that's an important point. There used to be compulsory cashing. So once you hit 65, you had to start taking your super. Now, you don't need to. So what we're actually seeing more and more of is people going, well, I don't want the money, I don't need the money. If I don't have a pension in place, I'm in accumulation phase inside my super fund, and I'm paying a maximum rate of 15% tax. That's not the worst tax rate to be in. As soon as I put a pension in place, I have to take money out. Now, I still think that the benefits of having that in place is probably going to outweigh 9 times out of 10 the withdrawal, especially while we're in this period of 50% reductions. I think we'll find, like we've had I think 5 years of this now. It's going to be interesting when suddenly people have to go back to taking their full pensions. We've had member balances go up, then suddenly people get older. So as you get older, the requirements of what you have to take out go up. So next year, in the 2024 year, you might find people have been taking out, $100,000 as their minimum. Suddenly it's going to be 200, 220, depending on what it is. So liquidity becomes potentially a bigger factor next year. And I tend to feel that's some of the reasoning behind the government's decision to extend it, is that they're still concerned about liquidity. People have potentially been going back into the market. People have been buying properties, etc., and getting used to not having to take out as much. But no, you can stop your pension at any time, I think, is an important point though.
You've mentioned a few times people having 3, 4, 5 super funds. Even if they hold a self-managed super fund, is that something you're still seeing a lot of? And what's the strategy? Are they trying to hold insurance policies in place, or?
Yeah, a couple of main reasons I see people hold, well, probably 3 mainly. Firstly, they just haven't been bothered to move everything. Secondly, people still see it as a bit of diversification. Like I say before, some of the big funds get access to investments that you can't get. Like, if I want to be exposed to a big airport in Paris, I can't do it. Whereas, some of the big funds can, because they've got that scope. So there's potentially investment reasons why people still maintain super in certain funds. And the other main one is, like you say, insurance. If you've got insurance in an Apra fund, you've got your self-managed super fund, there may be medical reasons why you can't get new insurance, or it just makes economic sense, like it's too costly to get it in a new insurance policy. So plenty of people maintain separate super accounts for insurance purposes.
Sorry, I didn't know much about the self-management super fund before, so I have some fundamental questions. First of all, I just wonder, is there some minimum balance or minimum fee in the super before Mazars can apply the self-management super fund? And second, if I do this through Mazars, your company, how much the costs and how much the annual benefit?
Okay, so the question is for setting up a self-managed super fund, is there a minimum balance requirement? And the second part of that question is a bit trickier, is how much does it cost to then look after it? So answering the first part, technically no, there's no minimum amount, but given that it's a financial product, no one will give you advice to set one up if you don't have minimum probably $250,000, because it's probably, a licensed advisor won't say it's in your best interest to do it with less than that. The ASIC guidelines are leaning more and more towards having $500,000 in super, which when you get maybe a couple together, two people have $250,000 each, suddenly you've got $500,000. You can also, and again, I won't go into the complexities there, but you can have up to 6 members inside a self-managed super fund. So if you've got 6 people pooling money together, you can get there pretty quickly. There's a lot of ramifications of having me and Andrew in a fund together or something like that. So I won't go into that, but hence I always seek advice. And as to costs, again, depends on what you're doing. So we charge as a firm like ours, dependent on still the old methods of time, like how long does it take? So if you've got 4 pensions and you've got 120 investments and they're all complicated and they're all unlisted and this and that, it's going to cost you a lot more than the person that's in accumulation and they've got listed shares and cash. Now, again, you can be going, there's a lot of providers around that provide different services, different costs. So again, you can always be shopping around, compare and find something that suits you. And again, I'm not having an ad for Mazars, but the less you pay, probably the less advice and I guess contact that you'll get. So, but that suits some people. The more you pay, you tend to get a bit more proactivity and hopefully a bit more diligence in what's going on. So, but yeah, there's no hard and fast around it. That's for sure.
Isn't that twice a year you've got to pay like $500, for the self-managed super fund? Two forms? No?
So the question is there $500 you've got to pay twice a year? Well, it depends on who you're paying it to. I'm not too sure, but there is I always love for the joy of having a self-managed super fund, you do pay the ATO what's called a supervisory levy. So currently it's $259 when you lodge your tax return to come and look at you and supervise you. Luckily, I don't have to do that when I lodge my personal tax, but you're effectively paying them to hire resources to come and check to make sure you're doing the right thing. That's hard and fast. You can't get around that. You pay that to the ATO. The only other fee that you will always have to pay is an audit fee. Like you have to get a fund audited by an independent auditor. So you may prepare the financial statements yourself and you can potentially do that, but you've got to get a qualified registered super fund auditor to say that you've complied with the rules or you haven't and report that to the ATO from there. So that may be, what you're thinking, but otherwise it depends on who's doing it. You can pay different levels of fees and
I've got a question for you, Andrew. Perhaps I'm not quite sure if it's appropriate.
That's all right.
But how's CFMG going? Are you getting a lot of opportunities to make new developments versus getting your capital raising?
Yeah. So the question is I'll shorten it to how's CFMG going, and the answer's good. So I think if we go back 2 years now to just right at the beginning of the pandemic, there was a lot of panic in the markets, including in our space. We took a position that it was an opportunity as opposed to something that was going to destroy our business, and as a result, I think from April 2020 to about October 2020, we would have increased the headcount in the office by about 30%, which was fairly rare during those times. Obviously, the economy and the property market in particular got heavily stimulated, which certainly suited us. And there was some elements of luck there as well. We had projects that were uniquely well-timed to take advantage of some growth in the market, particularly with the Builders Boost. If you had stock registered or close to registered, it was the most attractive stock on the market. We happened to have quite a lot of that at the time, which was good. That allowed us to create more profit, reinvest that capital into projects. And then also there was, certainly through late 2020 and 2021, we've always had a very strong reinvestment rate. So most of our investors stick with us and reinvest their funds. But that was probably the biggest period of growth for new investors during that time. And I think that was people, as Clive said, taking more interest in their money because it was very topical about people's livelihoods and The share market was doing different things, property market was doing different things. So everyone was becoming more proactive in their investment, and as a result, they were looking around at all the different various opportunities, and we were very much the beneficiary of that. In terms of finding new projects, we probably haven't been as active as we'd like to be interstate, and that's because we had 2 years where we couldn't go interstate. So it's a lot harder to buy a site, say in southwest Victoria or southwest Melbourne, if you can't get on a plane and go and eyeball it and walk it. Doesn't mean we didn't try, but also Queensland, we feel while we're based here, it's not deliberately our focus, but we're heavily, I wouldn't even call it focus. I'd say we're heavily weighted to southeast Queensland because that's where the best opportunities currently sit. Over the last sort of 20 years in my time in the industry, the way the market works is quite often the Sydney market will boom, the Melbourne market will follow. Queensland follows a much more linear growth pattern. Certainly has cycles of boom, but doesn't have those enormous growth periods over a short period of time. It doesn't go like that and then flatten out. It's just sort of steady and then flattens out. And because both Sydney and Melbourne enjoyed a pretty strong growth period, certainly through 2021, as did Brisbane, the underlying reasons for that were different. Certainly, it was a bit of monkey see, monkey do for a while there, where everyone was just jumping on the next property they could. But Queensland has much better fundamentals in terms of infrastructure investment, net interstate migration, and the key one's probably affordability. So even now, while we've had circa 20 to up to 40% growth in some areas of southeast Queensland, in comparison to Melbourne and Sydney, we're significantly more affordable. So a lot of those people interstate are investing their money in southeast Queensland property. I was having this conversation with Scott probably 3 to 6 months ago. It was a bit of a quiz, but there's over 50 suburbs in Sydney with a median house price over $3 million. In Brisbane, there isn't any. So that just puts makes you realise how affordable we remain, despite, if you've got, and I've encountered it in my own, I guess, personal life where you meet a new parent who's got a kid at your child's school, and you're getting to meet them, and they've relocated their job from Sydney to Melbourne in the last 2 years and sold their house 65 kilometres from the Sydney CBD for $2 million and bought on the river in Brisbane. I'm thinking, how good is this? So Brisbane's still seeing the benefits of that as well. And where we'd have approximately, I should know, but about 10 projects on the go at the moment, of which 8 are in Queensland, southeast Queensland.
A couple of things on that. The Olympics in 10 years' time is obviously a great coup for Brisbane. Does that affect your strategy of weighting more of these developments in southeast Queensland? And also during COVID, there was a massive influx of people getting out of Melbourne and coming to Queensland. Has that also affected your decisions to develop more?
Yeah, so other questions are relating to both the Olympics and its impact on our strategy in southeast Queensland, and also the net migration from interstate and whether that's affected it. Yeah, the answer is yes. But we were already, before COVID and before the Olympic announcement, we already felt southeast Queensland, and it's easy to look back in hindsight, but if you go back to some of our reports or our newsletters or articles that went on our website, we were talking up Queensland back into 2019 already. The Olympics is certainly it's a shot in the arm, but fundamentally Queensland was already on the up. And for a residential land developer, it's probably not going to have as much impact as someone doing a retail hub or a mixed-use development in inner city Brisbane that's going to directly benefit from the Olympics. But for us as a land developer that's building and developing in the growth areas of outer Brisbane, we'll benefit massively from the infrastructure investment that goes on, the boon to the economy, the employment rate, and things like that. And then in terms of the net interstate migration, probably didn't benefit directly from those people moving, because a lot of the people moving weren't buying in projects, the sort of project that we deliver. But those people that stayed or moved up here and wanted to invest in property, we saw a lot of those people buying in our projects, buying a rental property and things like that. But again, as I said, it helped us, but it didn't change our strategy because we were kind of already there.
I just wondering, like the Queensland government, they announced new land tax policy, commencement from next financial year. So from next financial year, they will charge the land tax, calculate land tax, including Queensland land and also other land in other states. So I'm wondering, like, will they affect lots of interstate investors?
So the question's about the recent announcement of policy change in land tax in Queensland, where basically, this wasn't part of the question, but I'll explain anyway, they are double charging you land tax. So if you hold X amount of property in Victoria and if you have over $1 million worth of property in Victoria, you'll pay land tax. The Queensland government's now counting that towards your land tax bill in Queensland, even though you've already paid land tax in Victoria. It will affect individuals. It won't have a massive impact on us. Certainly someone looking at buying investment property in Queensland would take that into consideration, and it is a ridiculous tax. But it's a drop in the ocean for us in terms of it's not going to have a direct impact on what goes on with us. Victoria's done something almost equally as silly. They've got a thing called a Windfall Tax. So basically, if you make too much money, they'll tax you just for having a windfall. So if Farmer Joe's got 50 hectares 100 kilometres from Melbourne that gets rezoned, even though he's lived there and farmed there his whole life, if he has to pay a tax on the uplift as a benefit of the land getting rezoned. Whereas previously, if you got rezoned, it's been your principal place of residence, you might have paid 10 grand for it in 1952. You sell it for 100 million, no tax. Now they pay a windfall tax on the uplift from the rezoning.
Hi Andrew, I just want to ask, like, CFMG Capital is always only doing land development, right? You don't do the build, right?
Yes, so the question is CFMG only does land, and do we do the build? And now the answer is, and are you referring to apartment building or house building?
Whatever, like all your projects, is it only, the scope is only development, right? The land development.
So the question is, do we only do land? And the answer is yes. Do I see that changing? The answer is no. We know what we know. We're experts in land. Certainly right now you wouldn't want to be building anything. Building is a pretty risky game right now. And as a result, we'd like to stick with the low risk things like land, roads, footpaths, stormwater, sewer.
So given that comment, and given that we're in an environment now of increasing interest rates, conversely your projects, the margins or the returns are diminishing. Do you see that they will continue to diminish?
So the question was, the interest rates are rising while CFMG's returns are diminishing. Not sure I'd use the word diminishing, but okay. that's fair. That's fair. So, give a background for anyone that's new. We spent the first X amount of years of our operation through the Land Opportunity Fund paying 12% on every single project we did, regardless of whether it was 6 months, 12 months, 3 years, 4 years. There's an element of building a business on the basis of that was required, but also as we got more successful and were able to deliver those returns, we looked at, do we need to pay 12%? Are we missing out on projects because of our requirement to pay our investors 12%? Therefore, we need to find a project that delivers a margin significantly above 12% to make it worthwhile. So it was a twofold thing. We might assess a project that would work if we're paying investors 9.5, but it wouldn't work if we had to pay investors 12. So missing out on opportunity by doing that. And also a project, for example, that's signed, it's got a development approval, we've sold 90 out of 100 blocks, and you're only going to be in for 12 months. Is that worth 12%? No, it's probably not. So, whereas if we're locking your money away for 3 years, the return should be, we feel, should be higher. And so far, most investors have agreed. Granted, they would all like to go back to 12% on everything. But I think the key, one of the key ones is missing out on opportunity for our requirement to pay 12%. So if you're assessing things and every time you already know you're clipping 12% off it to give to the investor straight away, suddenly you're missing out on things that you would have otherwise been able to do. And it's a lot harder to find sites that make enough money to pay investors 12 and enough for us to continue operating a business.
But do you see the interest rate affecting that margin even more?
No, it shouldn't. It shouldn't. I mean, one of our funding sources obviously is the investors. So, but then we get first mortgage construction funding through our land and opportunity fund through the banks, and those rates are going up. But hopefully, conversely, civil construction rights prices should hopefully settle in the next 12 months. And then also less competition, hopefully, because people, you know, the cowboys that jumped on during the boom get found out when things slow down a little bit.
Andrew, we're just about we're a little bit over time for
Yep.
the online folks, so we might wrap up in a minute. I just had one question for you both. Given the context of tonight and around SMSF and the role that it plays in everyone's investment strategy, with regard to CFMG Capital and our two fundamental products, whether they be the Land and Opportunity Fund or whether it's the First Mortgage and Income Fund, is that something that needs to go through an SMSF, or can it be done outside of an SMSF? If you wouldn't mind just talking us through that.
Yeah, so the question relates to both of our main products, being the First Mortgage and Income Fund and the Land Opportunity Fund, in relation to obviously the presentation from Clive focusing on SMSFs. Do they need an SMSF to invest? No, the short answer is simply no. You can invest via any investment vehicle you want into our fund, but the most common source of investable cash, I haven't got the research in front of me, but for someone that's sort of 25 to 50, unless they're extremely wealthy, and making large amounts of disposable income, the best source of investable cash will be their self-managed super fund. Therefore, our product is about 80 to 90% self-managed super funds investing with us. We do have some customers, including myself actually, who both invest in cash as well as via their SMSF, depending on which one's got money in the account at the time.
Yeah, I think the key from any investment in self-managed super funds is time frame. So, it's access to cash that people might not have elsewhere, but you're also able to take, probably depending on your age, a longer term time frame with your investment decisions. So, I think that's been great over the last few years of all the uncertainty and ups and downs. People investing for the long term in whatever it is will tend to come out on top. So. The other key there is just still that liquidity that I mentioned before, and that doesn't matter again whether you're investing in direct property via trusts or shares. You want to make sure, depending on your stage of life, that you've got sufficient liquidity.
Yeah, and certainly the first Mortgage and Income Fund is a relatively new product for us compared to the Land Opportunity Fund, and that was designed, I guess, as in direct relation to demand. So if you're an older investor that is relying on some of the income, our First Mortgage and Income Fund does pay a quarterly distribution, whereas obviously in our Land and Opportunity Fund you're locked and loaded for the period. So if you're a 25-year-old or a 30-year-old that's lucky enough to have investable funds, you probably don't mind going in a 4-year Land and Opportunity Fund project because you're not touching your super anytime soon. Whereas if you're 65, you might be more interested in the First Mortgage and Income Fund because A, you're relying on income, and 2, you don't want to be locked up for 4 years or 3 years or 2 years, however long it might be. So I think, we're a little bit over time. for our guests online. So we'll wrap it up there. Massive thanks to Clive Todd for joining us. Some pretty insightful stuff on self-managed super funds there. Be pretty hard to be passionate about self-managed super funds, but Clive is, so well done, Clive. But I guess we're all passionate about making money, so that's why I like self-managed super funds myself. So thanks to our online guests. Doesn't look like there's any more questions, so I guess we'll go dark online and enjoy some face-to-face conversation. So I'm not sure where to look. Thanks.